Why pay thousands of dollars a year for car insurance when you could get money back? Just for driving safely? While car insurance premiums in the U.S. continue to rise, becoming a financial burden for millions of Americans, one type of policy is quietly gaining attention nationwide: Dividend car insurance. This model is turning traditional insurance on its head, offering not just protection against risk, but also the possibility of receiving a refund if the insurer performs well and you don't file any claims. Unlike traditional insurance where you pay and get nothing back unless something bad happens, Dividend car insurance introduces a novel idea: profit sharing. Similar to earning dividends from a company in which you invest, policyholders under this model receive a partial refund, known as a dividend, when the insurance company has a profitable year and hasn't paid out excessive claims. However, this policy is not a free lunch. To be eligible for dividends, policyholders must meet several conditions. Most importantly, these plans are typically offered by mutual insurance companies. Firms are owned by the policyholders themselves, not external shareholders. This structure ensures that surplus profits are redistributed back to the customers, but it also means that premiums may initially be higher than standard insurance policies. The biggest advantage of Dividend car insurance is obvious. You can get back 5% to 20% of your annual premium. This offers long-term savings and also encourages safer driving habits, as Dividend are often tied to clean driving records and zero claims. Still, there are risks involved. The dividend is not guaranteed. If the insurance company has a rough financial year, due to increased claims, natural disasters, or economic downturns, you might not receive any refund, even if you did make a claim. This makes Dividend car insurance feel like a light form of investment. You're putting your trust in both your safe driving and the insurer's financial health. A common misconception is that this policy works like a no-claims bonus program. In reality, it's not a personal reward. It's a share of company profits. You might drive flawlessly all year, but if the company loses money, there's no dividend. So, it's crucial to evaluate the insurer's business model, dividend history, and financial strength before choosing this type of policy. Several well-known insurers offer Dividend car insurance, such as Amica Mutual, Liberty Mutual in some states, and various regional or nonprofit mutual insurance groups. These companies have a solid track record of consistent dividends. For-profit insurers usually don't offer this option because their profits go to shareholders. It's also important to note that not all U.S. states allow Dividend car insurance due to varying state-level insurance regulations. For example, states like California or Florida may have legal restrictions that make such policies difficult to implement. So while the model is attractive, access remains limited depending on where you live. So, who is this policy right for? The ideal candidate is someone with a clean driving record, low annual mileage, and a willingness to pay slightly higher premiums in exchange with potential to save money over time. Additionally, drivers who believe in policyholder-first companies rather than shareholder-driven corporations may feel more aligned with the mutual model. As America's insurance market faces mounting pressure, from inflation to soaring repair costs to climate-driven risks, finding sustainable and fair insurance models has never been more crucial. While Dividend car insurance isn't a magical solution for everyone, it offers a refreshing alternative for those who want more transparency and potential rewards for safe, responsible driving. To truly benefit from this type of policy, consider the following. Compare insurers carefully. Look at premium costs, dividend payout history, and customer reviews. Read the fine print. Remember, dividends are not promised. Don't budget as if you'll definitely receive one. Drive carefully and file fewer claims. A clean record not only protects your dividend potential, but also keeps your premiums lower overall. In conclusion, Dividend car insurance represents a modern shift in the way Americans think about risk and reward. It's built on mutual trust and shared outcomes. While it hasn't yet become mainstream, it's growing, and it may one day become the standard for how smart, safe drivers protect their vehicles and their wallets. In conclusion, Dividend car insurance represents a modern shift in the way Americans think about risk and reward. It's built on mutual trust and shared outcomes. While it hasn't yet become mainstream, it's growing, and it may one day become the standard for how smart, safe drivers protect their vehicles and their wallets. Backhand index pointing right if you found this topic helpful and want to stay updated on smart insurance tips and the latest trends in the U.S. insurance market. Don't forget to like, subscribe, and turn on the notification bell so you never miss a video. Your support helps us create more valuable content just for you.